But let me give you the honest answer. This is a very personal paper. And how did it all begin? So I have a French colleague who went down to the bank in our campus to withdraw some money in a joint account that she had with her husband. And the teller asked her, "Do you have your husband's permission to draw this money?" And she was very upset. And she came and told us, and we were also very upset because they will never ask her husband that question, that do you have your wife's permission? And it's a joint account. And on top of that, she makes more money than her husband. Anyway, so I thought, this is Hong Kong. This is an Asian country like Thailand. They are very conservative, and the men and women have different roles. Till a few years later, another friend of mine, and she's also French, and she works for a French school, and she went to buy some structured financial product from an actual financial advisor. And this financial advisor asked her the same question: do you have your husband's permission to buy this financial product? And this was really strange because my friend was a finance professor, whereas her husband is an engineer. He knows nothing about finance. So I said, this is some sort of very strange stereotype that people have about women and their knowledge of finance. So this is how this paper started. But this, of course, I can't put down in an actual paper. So in the actual paper, you have to give some good motivation of why this paper is important. So the first reason why this paper is important is that investors are of two types. There are institutions and there are retail. Retail means people like you and me. And most of us don't know finance. So when you want to buy and sell, we usually seek the advice of professionals. So it's like if you're sick, you go to a doctor, you don't treat yourself. So it's like a doctor for finance. So this is the financial advice business, and the financial advice business is very, very big. It's in the order of trillions of dollars of size, especially in the United States, and they make a lot of money. And I'm not going to put all the data down. In the paper, you will see that at least 30% of people seek advice from professionals, and it differs from country to country. So people seek advice, and this advising business is big business. The second important reason is the type of people that seek advice are men and women. Now, how important are women? Women are actually becoming very important. There is a PIMCO research which says that women actually have more wealth than men in the United States today, at least personal wealth. And of course, there's a fundamental reason for that. Women live longer than men, so they have bequested or they have earned a lot of money, so they're left behind a lot of wealth. So they need to go and invest it, and they need to advise. So for this industry, women are increasingly becoming an important customer. So this is a big industry. Women are becoming an important customer. So you put two and two together and you say, as the personal wealth held by women continues to grow and the investment more, and this is happening all over the world, it becomes increasingly important to understand the determinants of women's investment choices, which is how do women invest? Do they invest different than men? This is, of course, something that my paper will not do. But if they do, if a woman goes and asks for advice, is the kind of advice that this person gets is different from if a man goes and asks the advice. So, to put it very, very bluntly, do women get bad advice? Now, you may say, I have my view on that. But remember, we are not politicians. We are not religious people. We are scientists. A view is called a hypothesis. And a hypothesis is not the truth. A hypothesis has to be tested, and you have to test it against data. And if your view doesn't turn out to be right, you have to throw out your view, which is different from what a politician does. The politicians keep believing their views even if the data is against them. And the same thing for religion. Science, very humble. We will go where the data tells us to go. So the view is maybe women get first financial advice, but maybe not. So therefore, we will say, let us see what the data says. Okay. After you have motivated the paper, and you have put out a null hypothesis. Null hypothesis means your view, and you may have an alternative hypothesis, or you may not have an alternative hypothesis, which is an alternate view. Remember, these are views, these are not truth. And science, you never have truth. It's just substantiated view, which is substantiated again with the data. Okay, the next thing you have to do when you write a good research paper is you have to be very humble. So, what have people done about this research question? So, as Newton once said, if I have seen far, it's because I've stood on the shoulders of giants. So, here also, I stand on the shoulders of giants. And there are four streams of giants. First, there is this literature and financial advice. And I know a lot about this literature because I have a very well cited paper on this. And this literature mostly focuses on hanky panky that goes on in financial advice. I don't like this ting ting ting. It's very disturbing. Anyway, so the hanky panky that goes on in financial advice is you go to ask for advice, you're thinking about your own self interest. The financial advisor is giving you advice. The financial advisor has his own self interest. So there's conflict of interest. So most of the literature on financial advice is on conflict of interest. But there is other types of things coming out. And a paper that I would like to mention, because there are too many papers, is this paper Butcher Goinan, who basically asks the same question that we do. Do women get worse financial advice? So later on, I'll tell you how our paper is different. Okay. The second big literature stream is gender difference. Are men and women different? There's a huge literature the last 50 years. Yes, they are different. In certain aspects, they are not different in certain aspects. So, for example, men are more confident, men are less risk averse, and so on. And these are, of course, finance related things. There are lots of other psychological aspects too, where there's differentiation amongst genders. The third literature, which is just coming up, is financial literacy. Now, I know a little about this literature because when I was a professor at the University of Indiana, I was asked to give a talk to professors in the engineering and the sciences about pension funds. Now, these are very smart people who are top of their field, but I was very shocked to learn that they know nothing about finance. They don't know the difference between stocks and bonds. And here they are making money, but they have no idea how to invest it. So, financial literacy is now a burgeoning literature. Who knows finance, who doesn't know finance? And the big idea is that very few people understand finance. And on an average, women understand finance less than men. So that's another finding from this literature. And the last and the fourth thing is a methodology thing. So classically, when you do research in finance, you take a bit of data, it's called archival research, and you run regressions, and then you make a conclusion. So that's classical finance. But finance is very innovative. Now we are trying to take methodologies from natural sciences. We're actually trying to do experiments. So our paper is actually a real field experiment. And there's some great advantages in field experiments as well as disadvantages. And I'm going to talk about them. So these are four different types of literatures that we'll be touching on. I'll not talk about any of these papers because this talk today is not about their papers. It's about my paper. Okay. So now we have this thing. Then whenever you start a paper, you have problems. What is the first issue? The first issue, as anyone would tell you, when you do research using archival data and you run regressions, is that correlation is not causation. So the sun goes down usually and something else happens. It doesn't often mean that the sun is causing that. It just happens. So correlation as not causation is a big problem in finance. It's actually a big problem in the social sciences. It's not a problem in the natural sciences. So why is this a big problem? So as I was saying, there's another paper which actually asks the same questions. And this paper finds that women are given worse advice. Now, how do they do this? They look at recorded meetings, about thousands of recorded meetings between the advisors in a bank and their clients, half of whom are women, and they find that women on a whole are generally given bad advice, and they have their own definition of what they mean by bad. The problem is the following. So these meetings are meetings between an advisor and advisee. They are not randomly matched. An advisor chooses the advisee and the advisee chooses the advisor. And because they are not randomly matched, just analyzing meetings will not tell you anything. So therefore, we need to do some randomization. So that's the first issue. The second issue is, even if matches were random, advice may be affected by advisee characteristics that are unobservable to the researcher. Sorry. So what do I mean by that? So for example, if women are very risk averse and the advisor gives them very safe securities to buy, they're giving them safe securities to buy because they are risk averse, not because they are women. So therefore, we have to control for all these advisory characteristics, and we can't control for every advisory characteristic. So that's another issue. So I promised you this. Of course, I won't show to my PhD students, but I'll show to your master students. And let's see where I have my. Did I take it out? Uh, okay, let's see. This works. Yeah. So in usual social sciences, we have naturally occurring data. We have some model, and then to take care of it, endogeneity, we use instrumental variables, propensity score. So here, this is natural occurring data, lot of data, but then these are all correlations. This side, we have experimentation. These are the natural sciences where they actually experiment. So for those of you who've been following the COVID trials, the COVID trial phase 3, for example, why do they have control group and treatment group? Because they want to randomly assign the COVID to find out whether it actually causes the antibodies to grow. So this is the whole thing about the phase 3 trials. It's about experimentation. Now, how do you do it in finance? We start with lab experiments. The problem with lab experiments, with what will you do? You'll go to your school and you will hire undergraduate students and you will give them some 50 baht per hour or something like that. But this is a little artificial because undergraduate students behave very differently from the actual people. Then we have artifactual field experiment where we have these undergraduate students in the actual field. Then we have framed field experiment where we have real people in the real field and they know that they are being tested, like the COVID 3 trials. And finally, there is this natural field experiment where we have real people in the real field, but they don't know that they are being tested. So this is called the audit study. So basically what we'll do is the following, is that we will hire actors and actresses in Hong Kong. Of course, we don't do it, we outsource it. And we will train them and we'll send them to all financial advisors in Hong Kong. And actors and actresses will pretend to be clients and we randomly match them. And we'll record what the advisor tells these so-called clients. So this is an actual natural field experiment. So this is actual clients in an actual setting, but they don't know that they're being experimented upon. Now you may ask a very good question, which is this moral? Yes, it is moral if you ask permission from your from your university. They have something called the human subjects, so you have to get permission from them. We got permission from Hong Kong UST, but more important than that, it's in Hong Kong. This is actually legal. So we have these companies which actually do this for you. For example, Apple may want to know how is the Apple Store's service. So they will hire these guys and send them pretending to be clients to the Apple stores to find out how good is the quality of the service. So we hire these guys to hire these actors and actresses, and then I'll tell you the actual research design. So natural field experiment, and then we'll do a stratified random matching. What is a stratified matching? Well, some financial advising firms are big, some are small. So therefore, when you do the random matching, the big guys should get more visits. So that's why it's called stratified random matching. And then there'll be some attributes that will vary. So we went back to the literature. What is the big difference amongst men and women when it comes to finance? One is risk aversion. On an average, women are more risk averse. The other is confidence. On an average, women are less confident. And then there's nothing else. But then, since I'm very interested in home bias, we also added the attribute of home bias. So that's the first issue. Okay. The second issue is statistical versus taste based discrimination. So, for those of us, and I'm just new to this literature, I learned this. For those of us who want to study the discrimination literature, the classics in this field are the one by the Nobel laureate, um, Kenneth Arrow, of course, and Gary Becker. And they talk about the difference between statistical and taste based discrimination. So, what is statistical versus taste based discrimination? So, now let me give you another example, which is actually a little controversial. Again, COVID. So, I just came from Los Angeles, which has become the COVID hotspot of the world after London. And things are really bad out there. And whenever you're taken to a hospital, there's a person who's there called the triage. And this triage guy will figure out whether they should admit you or not admit you. Why? Because the bed's almost full. Now, if you're a black guy and the triage guy says, no, I won't admit you, it might mean that he doesn't like black people. So that is called taste based discrimination. Or he may say, no, no, it is well known that on an average, black people have more comorbidities, which means pre existing conditions, than white people. So, if black people on an average have more pre existing conditions, he thinks, what's the point of admitting a black guy because he's going to die anyway? So, this is what we call the statistical discrimination. It's nothing to do with the fact that he doesn't like black people. He's just basing it thing on the average of the entire group. So, that's something that we'll have to deal with. So, how does it come here affect this here? So, as I said, the average male and the average female differ in many dimensions. Let me get this small. Okay. For example, as I said, the literature suggests that women are less risk tolerant than men, have lower confidence, and they also have lower financial literacy. Now, let me be very, very clear. I'm not saying all women, I'm saying the average woman. I know a lot of women, at least all the women I know in my life, actually have better financial literacy than most men I know in my life. Now, so if these same differences carry over to the subset of men and women who seek financial advice, then the financial advisor may in fact be catering to these attributes rather than to gender. So, as I mentioned before, if a woman comes to you and you give her a very safe asset, it's not because you're discriminating, it's because you think that women on a whole do not like risk. So, if you do not control for that and you just look at a correlation, this correlation would appear in the data as gender differences, but it's actually because of different perceptions of risk. So, how do you control for that? So we'll experimentally vary risk tolerance and confidence and home bias and see if the discrimination still remains. If it still remains, then it could be taste based, but it could still be statistical because cannot really control for everything. So, bottom line, in all these studies, you can't really rule out taste based discrimination. So, everything that's left over is taste based. Okay, the third issue, and this is something I know a lot about. How do you measure the quality of financial advice? Now, you guys are master students in finance. So I know most of you, when you're doing investments, what are we doing? We are measuring alpha, which is risk adjusted return. So the quality of advice is measured by risk adjusted return. Well, that has its problems. First is what are the risk factors that you will take into account? But in our case, we have a more fundamental problem because remember, we are actors and actresses going to these guys, and these guys will give them some advice. They will not tell them an entire portfolio. You should put this much weight in this, that much weight in this much weight here, this much weight there. That's too artificial. So we cannot use this measure at all in our context. In archival context, when you do mutual fund returns or hedge fund returns, you can do this, but not in our context in an experiment. Okay, so that's after the fact. That's called ex post. Ex ante, those of you who do finance, Markowitz, we go the efficient frontier. You measure the distance from the efficient frontier, and the further it is from the efficient frontier, the worse the advice is. Well, this is even more problematic because how do you compute an efficient frontier? So, so even in the real world, it's difficult. In this world, it's impossible. So what else can we do? So I looked at the literature, and since I know this literature and the papers that have done this, I've used this method. It's a very clever method. You go to an advisor and you tell them, look, I want to buy an index fund. Can you recommend an index fund? Now, an index fund is very simple. They just track an index. So all index funds are very similar. So the only thing that differentiates between index funds is the fee. Since all funds are the same, the one with the higher fee is worse advice. So it's a very clever idea. Our problem is that in Hong Kong, we just have 3 index funds and 2 of them are not very well known. So when we did this pilot study, everyone is recommending that one. Plus, they were figuring out why are the hell these guys are asking us this strange question, recommend an index fund when they know that there's just one popular index fund in Hong Kong. So what do we do? So remember, this is actual research. We have all these problems and you have to solve them. So we said, let's make it very natural. This person comes to the advisor and says, I'm thinking of starting a business with you. I'm checking you out. I have so much money for my retirement. To begin with, give me some recommendations of what I should buy. That's the key thing. Give me some recommendations of what I should buy. Okay, so we record what they say. We'll define a financial advice as undiversified if the advisor only recommends individual securities. So we saw this in a pilot study. Many of these advisors were just saying, oh, buy this, buy that fund, buy that stock, buy that stock. So they're only recommending individual securities. Now, again, master students would know that individual securities have idiosyncratic risk, which you're not getting compensated for. So they're always dominated by baskets, a well diversified portfolio. So if an advisor only recommends individual securities, this advisor's advice is bad. Okay. The second dimension is home bias. If the advisor only recommends you to buy securities that trade in Hong Kong, local securities, that advice is bad because there are foreign securities too, which you can buy, and they offer diversification opportunities. So basically, it's all about diversification. Individual securities or just home securities do not offer diversification. And diversification is a good thing because the only free lunch we have in finance. You can actually reduce your risk without reducing your return because you're reducing your idiosyncratic risk. So that's our definition. Okay. And the last thing. So since I'm an editor of a journal and you send me a paper from Thailand and I'll say, why the hell Thailand? So people will ask me, why the hell Hong Kong? Of course, the answer is because I live in Hong Kong. But you have to give a really good answer. What is it in Hong Kong that offers you a unique opportunity to answer something interesting? So here's something that's extremely interesting in Hong Kong, which is the financial advice business actually is done by 2 types of business models. So first is what are called security firms. So what are security firms? They are like brokers. So if you compare to the United States, they are like full service brokers. So for those of you who don't know who brokers are, so if you want to buy and sell, you have to contact a person who will help you do that. And if you just do that, these guys are called discount brokers. Now these guys give you advice as well. They will be called full service brokers. So this is if you go through a human being. But as you know that these days many people are using robo advising too. So if you go through a human being and the guy is willing to give you advice, so these guys are called full service brokers. In Hong Kong, they are called security firms. What is the business model? It is arm's length. So we visited a few of them. People come and people go. It's low margin, high volume. They do not care that much about catering because all these security firms look the same thing. You don't like me, go somewhere else. It's the same type of service. How do they make money? So because they are brokerage houses, they like you to trade. They like you to trade because their money comes from trading commissions. So what trades a lot? So if you recommend individual securities or home securities, individual securities trade a lot. Mutual funds, they trade much less, just once a day. So these guys therefore like to, there's a conflict of interest, would like to recommend individual securities. And they recommend home securities, they have to share their commissions with the foreign broker. So therefore they like to recommend home securities too. The second type of business model are financial planners. So financial planners are like private wealth managers in the United States. So again, the metaphor is if you go to a gym and you want to work out, and there are the guys walking around, and you say, "Hey, what should I do?" He tells you, "Do this, do that," and then he disappears. Those are like security firms. A financial planner is like a private trainer. So they're private wealth managers, and in Hong Kong, they also advise retail clients, not just rich people, but also middle class. So what's the difference? In many countries of the world, including the United States, there's no sharp distinction. In Hong Kong, there's a very sharp distinction. Either a security firm or a financial planner. You're not both. So the business is relationship oriented. It's high margin, low volume. And because they care about the client, they cater to the client. So that's the issue for. And finally, since they cater to the client and they don't share in all the trading commissions, they also recommend financial products that do not trade, like insurance products, commodities, gold, mutual funds, for which they receive side payments from the guys whose products they're trying to sell. So this is how the compensation is. Okay, now let's do the research design. Advisory firms. So Amit, my student, took him about a year. He went to the Hong Kong government website and found out that there are 14,000 people, about 14,000 people who have license to be financial advisors. Now in Hong Kong, you cannot be a financial advisor unless you actually take an exam and take a license. Now he linked all these guys to the firms that were employing them. And then he threw out all the foreign firms because we don't care about foreign firms. And we threw out banks because if you want to investigate a bank, you have to be a depositor. So at the end of the day, we found out there are 65 local financial advisory firms in Hong Kong. Now note, and this is one big thing in our paper, this is not a sample, this is the population. So of these 65, 13 are financial planners and 52 are security firms. Financial planners tend to be small or medium size. Security firms, most of them are small, but there are two very, very large security firms. So when we do stratified sampling, we'll send a lot of guys to these people. Okay, so then we hired a mystery shopping company. So these people who we outsource it in Hong Kong, it's an industry called mystery shopping companies. And then we asked them to choose 16 males and 16 females, 30 to 45 years of old, because these are the classical ones to invest. Have to be Hong Kong residents because the guys will ask them for the ID. Because as you will see, A lot of this paper is testing a theory on financial literacy. So we wanted them to have be non-college and have limited financial experience. Okay, we told them fill up appointments, they had training, do not lie about your age and something like that because they can easily check you. So age, education, net worth, you have to fill up a questionnaire, tell the truth. But this is where you're going to lie. Of course, you're not going to lie. So there's a conversation, and in this conversation, you will insert some key sentences. So remember, there's 16 and 16. So half of them we put them as high risk tolerance, and the other half as low risk tolerance. So these auditors, these people we chose, we gave them avatar. So if you have a high risk tolerance avatar, your key sentence would be, I don't mind if I lose money sometimes in bad times, but I want to make good money when the times are good, so I can afford to lose some money. If you have low risk tolerance avatar, then you want to have to say, I want to buy something that's safe. I worry that if I make a mistake, then I lose my money. I can tolerate a little loss, but not much. Of course, they will say this in Cantonese, and they will say it in a way which comes naturally, not. Then the other one, avatars were high confidence and low confidence. So high confidence avatar was, I usually make financial decisions myself. I don't usually take the help of advisors. I'm only here because my good friend insisted that I meet you before I make my decisions. Small confidence. I've never made important financial decisions on my own before. In my household, my parents or spouse have always done this. That's why I need your advice. Then outlook. Someone with an international outlook has to say, my cousin lives in Canada. Why is it? Because in Hong Kong, most people with international have someone living in Canada. And I'm thinking maybe I'll move to Canada. I'm not sure that I want to retire here. Someone with a local outlook will say, I was born here and I intend to retire here. And we told them, do not mention any relatives that live abroad, even if they do. So basically, if you are a auditor, you have been given an avatar, which is three-dimensional avatar. A dimension called tolerance, where you could be high or low. A dimension called confidence, whether you could be high or small. And a dimension called outlook, which you could be local or international. So one avatar has just one of these permutation combination, and they undergo training for a week to make sure that it's drilled into them. They don't change the avatars because that would be too confusing. And they will keep that avatar for 6 months when they are going to these various places. So we send them. So each of these financial firms get about 18 visits. Each avatar does about 20 visits. Uh, Sorry, each of the financial firms get only 6 visits because we are scared that after 6 or 7 visits they'll be found out. As a matter of fact, in about hundreds of visits, there were 6 of the avatars who were discovered to be fraud. So we had to throw out that data. So we visited over a bunch of 6 months, and fortunately, all our research, the field research, finished because before Hong Kong started having its political problems and then its COVID problems. Okay, now this is probably what you guys are all waiting for. First result, the quality of financial advice. So when you guys do your work, you'll have tables and you'll have to show tables. And so do we have tables, and our tables become more and more sophisticated, and we use more and more sophisticated financial econometrics. And the cleverer you are, the better the financial econometrics you use. But I'm doing a presentation here, and I'm not trying to impress anyone. I'm just trying to tell you the basic result, and the best way to present is to show pictures. So let me show you pictures. So not bad is 0 and bad is 1. So remember, what is undiversified advice? If someone says you just buy 2 securities, so that's bad advice. So of the proportion of people who give bad advice, if everyone gives bad advice, it's 100%. If no one gives bad advice, then 0%. So what do we find? The quality of financial advice in Hong Kong is terrible. 38% of all advisors ask you to buy single securities, one or two. What about home bias? It's equally bad. It's also 38%. 38% of them just ask you to buy local securities. So the takeaway is quality of financial advice in Hong Kong is bad. Now, if you're a master's student, you'll probably leave it that, but we are trying to write this paper for a top journal. So therefore, whenever we have empirical work these days, it has to be theoretically grounded. So basically, you need a model. And in our case, we really need a model because we are getting a lot of very complicated results and we wanted to tell a simple story. And without a model, you can't tell a simple story. At least we couldn't. So, what is this model? Which I'm not presenting to you, but I'll give you the intuition. The model is you're a financial advisor. You will give advice that makes you money. And then advisee comes and advisee asks you for advice. Now, what makes you money? What gives you money is trading commissions. So you make a lot of money by giving single securities or by recommending local securities. And that's the reason why the quality of financial advice in Hong Kong is bad. So it's just because of why? Conflict of interest. So this is the first ingredient of the model, which is the conflict of interest. And this assumption is very, very natural because in economics, everyone works for their own self-interest. So do financial advisors. Okay. So that is okay, not that surprising. Who gives worse financial advice? Now let's break it up. Who tells you to buy just one or two single securities? The security firms are bad. The financial planners are not that bad. So basically, security firms are the ones who give you very bad advice. Not that the financial planners don't give you bad advice, but they give you much less. And when I put a circle around that, that means there's not just difference visually, but there's a statistical difference. What about home bias? Home bias, we still see security firms worse than financial planners, but there's no statistical difference. So, bottom line, security firms are more likely to give undiversified advice than financial planners. No difference for home bias advice. Why? Now you need a model. So notice security firms make most of their money from trading commissions. So therefore, they are likely to recommend single securities because they trade a lot and local securities for which they get the commissions. Financial planners get their money from other sources as well, like they're recommending the mutual fund of someone or the insurance product for someone. So therefore, this tendency is lower for them, and that's the reason. So SFs make more money from trading commissions than do FPs. So that makes sense. So result two is also, I would say, not that surprising. So whenever you have a good paper, you should start getting results that surprise you. This is the most surprising result. What do we find? That security firms are bad, but they do not discriminate. So notice male and the female in security firms about the same. For financial planners, females are given much worse advice than males. What about home bias? We see the same thing. Security firms are bad, financial planners are better, but they actually discriminate against women. So the bottom line is very surprising. The guys who are bad are equal opportunity abusers. The guys who are better are the ones who are actually discriminating against women. So though financial planners give better advice than securities firms, financial planners discriminate while securities firms do not. Now this is very interesting, and that's why we need a model. So what is the reason then? So notice I said that there's conflict of interest, right? But look at the business model. Security firms, people come and go, and we're giving you bad advice. You don't like me, you go somewhere else. So don't quite care about their client. So they don't care about client characteristics. And one of the fundamental and salient client characteristic is the gender. So don't quite care whether you're a male or a female. Whereas financial planners, they care about their client, and the first thing they notice that this is a woman. And this is another assumption of the theory model, is that they know there's so much literature out there that on an average women are less financially literate. So they think they can fool women more. So that's the reason. Why? FPs cater more than security firms, so they are more sensitive to client characteristics like gender, and they believe that women can be fooled. So we have to have all these ingredients coming in. So that's the most interesting part of our paper. So though that's the most interesting part of the paper, from an academic point of view, the fundamentally important result is result number 4, which is, remember, we guys are not really into this gender business, but as an economist, everything is about incentives. So what we find in result number 4, in my view, is very, very interesting, which is that there is a subtle interaction between incentives and statistical discrimination. So let's look at this again. So now, who did discriminate? Financial planners discriminated, security firms don't. So we don't care about security firms anymore. Let's look at financial planners and let's dig deep. Remember, we are varying all these attributes: confidence, risk aversion, geographic outlook. What do we find? And this for only for financial planners, that whenever a person comes with a large confidence, there's discrimination. Not much when you have small confidence. Risk tolerance. If someone comes with a very high risk tolerance, there's discrimination. Not so much if the person has low risk tolerance. What about home bias? If someone comes with an extreme domestic outlook and you're catering to that and giving them home bias products, you're discriminating against men and women. Not so much here. So basically, what's happening is, if your confidence is increasing, you're being recommended more to buy more and more single securities. But this is happening more for women. If your risk tolerance is increasing, you're being recommended, so there's been catering taking place, but they're catering more towards women. And the same thing with domestic, that they're catering more towards women than they're to men. Here, actually, for some reason, it's going downwards. So, bottom line, what's happening? The financial planners, the gender difference in advice. So, on an average, we find the gender difference in advice doesn't depend on confidence, risk tolerance, or on outlook. We control for that, it still remains. But we dig deeper and we find out what happens if it's large confidence and big risk tolerance and domestic outlook. And we find that's where the gender difference is taking place. Why? FPs believe because of catering, everyone wants to be catered. This guy wants to be catered. This guy wants to be catered. So you are catering to them. Remember, this guy is giving things in his own interest, and you're catering to your client. But then at the back of your mind, you think, the client may find that I'm a bad guy because the client has financial literacy. So I may be outed if it's a male. The probability of being me outed is less if it's a woman. And therefore, the women are being catered more and being given all this bad advice. And this is happening only for financial planners whose incentives are different than for security firms. So, those are our 4 main results. We've been presenting this paper all over the world. One question that people always ask us is, okay, so these guys go to a firm and the firm gives them a person and the financial planner or the securities firm, the advisor. What is the sex of this advisor? In other words, who are the bad guys? Are the men discriminating or the women discriminating? And we find, as many of you suspected, it's actually the male advisors who are discriminating in financial planner firms, not the female advisors. However, remember, we are scientists. We are not controlling who will come and advise us. So this is not random. So we cannot attribute causality. It's just correlation here. But it's an interesting result, but a side result. The second question that people ask us is that if you're a woman in Hong Kong, you know that security firms are bad, but they don't discriminate. Financial planning firms are better, but they discriminate. Ex ante, who should you go to? It's a very good question. We can answer that. Actually, doesn't matter, as you would suspect. Ex ante equally likely to receive dominated by either type of firms. So I repeat why. Because one guy is bad, but he doesn't discriminate, and the other guy is good, but he discriminates. And do you have any more results? So remember, we were recording everything. Financial planners are more willing to give advice, spend longer time with clients, ask more questions. And this is an assumption in our model, which is actually affirmed by the data. But again, I stress it's the financial planners who are discriminating. Okay, so let me present my last slide and then we'll open it to questions. So, what is the contribution? So, again, this contribution should be in the first page of your paper and the last page of your paper because most people don't read anything else. As a matter of fact, most people just read the title. So, how is your paper different than other papers out there? Well, first, there are papers now that are trying to look at gender discrimination, lots of papers. And there's one paper which looks at gender difference in the quality of financial advice. But I wouldn't like to use the word it's flawed, but the better methodology is to actually do a randomized experiment. So it's the first paper to use a natural experiment. Most people, like my mother, are not interested in methodology improvements. They say, do you have some interesting results? I'll tell my mother, yeah, I do. The interesting result is, on an average, men are more risk tolerant and are more confident. So therefore, we'd like to see that women and men are given more risky securities to buy. But this paper finds surprisingly it's the women in general, and especially risk tolerant and confident women are more likely to receive undiversified advice than similar men. What's going on? More surprisingly, the firms with the worst advice do not gender differentiate, but the firms with the better advice gender differentiate. So we're getting lots of subtle results. So we have to weave everything to a story, and that's why we have the model, which is the results are not driven by simple statistical discrimination, but it's an interaction between incentives and your prior beliefs. Remember, security firms, they want to get as many commissions as possible, so they give very bad advice. They're not client specific, so they don't care about men and women. Financial planners, they care about men and women. They like to retain your business, so they give you better advice. But they are catering more to women, but they're catering to the bad habits of women more than to men. So different types of financial advice with different incentives respond differently. So that's why we need a theoretical model interprets these patterns as an interaction between statistical discrimination advisors and incentives. Finally, so who are being discriminated? A woman who is cocky and confident, a woman who has very high risk tolerance. Now, these are people who are going against their gender stereotype, right? Now, our model says that this is rational, it's a statistical discrimination. But we cannot rule out the fact that it could be taste based discrimination, which is you don't like women who go against their stereotype. But we doubt that because why is it that only financial planners do this taste based discrimination and the security firms don't? But we can't say much. So that's the contribution of the paper. With that, I end and I open up to questions.
Uh, Thank you so much. That was very interesting presentation and the topic, including the findings. I think some of the features are similar to what's happening in Thailand as well.
Thank you. Yeah.
So let me first ask the question from my opinion. I'm wondering the way that the financial advisors are providing the service in Hong Kong. suppose that you have somebody walking into the office, right? How would they assign somebody to take care of the client who is walking in? Do they like, I'm not sure, see who
So,
first and then ask somebody to take care of?
so I'm glad you asked this question. So, usually the financial advice business is like it's like going to a doctor. So, our paper is all about the first time visit.
Hmm.
So, once you've established your relationship and you go and visit the doctor again and again,
Hmm.
then whether there's discrimination or no discrimination, we can't say anything about this. So, this is basically about the first time visit. So, when you go and for the first time visit, you set up an appointment. So we had found this out from our pilot study, and we tell this, so the person asks what's your name and things like that, to give their real name, and then they set up a time and a date, and this person comes there, and then the receptionist says, oh, you have come for financial advice, and then someone comes and takes you to another room, and then they assign someone. Now your actual question, how do they assign that I don't know.
Okay. So we can pretty much believe that this process is random.
uh, yeah, so I think what you have in mind is the following, which is that we thought, for example, if a woman comes in, she's been assigned a woman advisor, and a man comes in, she's been assigned a male advisor, or it could be vice versa. So
Right.
we actually checked this. Fortunately for us, we found that there was complete they're equally likely to be assigned to a male or a female.
Okay.
Of course, in Hong Kong, as in most places of the world, there are many more people with financial licenses that are men than are women. So 70% of financial advisors are male, then and 30% are women. So if a woman comes in, her chances of getting a male is 70%. If a man comes in, her chances of getting a male is also 70%. So there's no discrimination. So background.
One more question. I think it is. I'm not sure how how do you deal with like the ethical issues in the process of recording the advice, right? Is there any?
No, I shouldn't have said recording. When I said recording, that you shouldn't have taken me literally. No, we don't record anything. We cannot by law. So these mystery shoppers, they go in, and as soon as they come out, we've given them an app, and they have to answer these questions, what was told and things like that, so they don't forget it.
Oh, I see. Okay, I see. All right. Yeah. Well, that's for me. Audience, do you guys have any particular questions? Yeah, feel free to ask.
I have one. Manapon, I have
Yeah.
one.
Yes, please.
I'm not sharing video because my connection is not so good.
Oh, that's okay.
I'm at home. I'm a faculty at the department. Um, I'm wondering, I may have missed part of your presentation, and but I'm wondering whether the male and female, male versus female advisors give sort of comparable quality advice in terms of the bias.
Oh yeah,
Um,
so sorry, yeah. Actually, I answered that towards the end. So what do we find is the following: the male financial advisor
mhm.
discriminates against women.
Okay,
The
and
the female financial advisor does not discriminate.
okay, okay. So the results mainly come from the male populate, the
Yeah,
male
yeah,
subsample. Okay,
yeah,
I missed that. It was
yeah.
uh, wondering. Okay, and just one more question, perhaps not so relevant to the paper directly. In Hong Kong, um, the investors in general, the clients tend to be male or female. I mean, I suppose perhaps male, but is are the proportions very different?
No, that's again an excellent question, because what's a baseline study? Because so one thing I can say that we did a comparison across various parts of the world. Uh, so in China, uh, and basically in mainland China, I wouldn't know much about Taiwan, but in this part of the Greater China area, females are very active in investments.
Mhm.
So there's a lot of female investments. So I don't remember, but I think the proportion was 40% of investments is coming from female and 60% is coming from men.
Hmm.
in Hong Kong, which is much larger than most countries in the world.
For the female, you mean?
Yeah, for the female. Yeah,
But
it's
the-
still not equal. It's still not equal, but the female representation is very high.
but to me that's quite close. I'm not sure about Thailand,
Yeah.
but the investors in Thailand that I know, female ones, I use the let's say the layman's term, quite picky.
Yeah.
They're
Yeah.
quite picky. They get into the very detail, the female. So I would develop an impression that for the Thai market, um, or or Asian countries, it would be hard to fool female who go to stock market.
Yeah, so actually, so this is what many of my Hong Kong friends are telling us because they have the same feeling here that the females are very picky.
Yeah.
So I said, yeah, but that's your perception, but the females are getting fooled more
Hmm. And
because they're
if they have doubts, they tend to be aggressive as well in this
yeah,
part.
yeah, but remember, it's very easy to sell
Mhm.
individual securities because
Mhm.
all you need to sell individual securities is a very good story. And
Right.
if you're a good storyteller, you can impress any woman.
Mhm. And also, could I ask one more question?
Yeah,
Let's discuss. Um, if I understand, if I follow you, your paper correctly, good advice is going to be say invest in um, an index,
yeah,
right? Or have a diversified portfolio to construct
yeah,
diversified portfolio.
yeah,
Um, but that's not based on private information, is it? If the security advisor has private information, they'd be better off go stock
yeah,
picking
yeah, yeah,
rather than diversified portfolio.
yeah, yeah.
So I mean, I cannot remember the paper in the journal that's called Applied Finance. I think there's
Yeah,
a paper written by Phil Diffie. It was a
yeah,
bit like communication.
yeah,
So basically, the one of the key messages, if I remember correctly, is that um, um, fund managers, if they're good, they go stock picking, or people, investors in general, if they have
yeah,
private information.
yeah.
Um, however, they get the private information, they better go with stock picking
Yeah, no, no,
rather
yeah,
than.
you're very good point because if I can put your question more succinctly, what you're saying is if I go to a financial advisor and this guy says buy an index fund, I'll say,
Yeah,
why am I paying you so much? I know that from
that's right.
taking my job. You have to give me some secrets. That's true.
That's
And
yeah.
this is
Or they,
and this is a question that we have received from very many places. So we said, what the hell? So let's look at all these stocks that these guys are recommending, and are these guys hot stocks? So we
Mhm.
did the usual thing. We calculated we found out after the advice was given of this hot stock, how did this hot stock do compared to the market?
Okay,
And our answer is the following: it did not beat the market.
okay, okay.
And as a matter of fact, the alpha is actually very similar to ex ante thing. So basically,
Mhm.
we still find that security firms are worse than financial planners, and financial planners discriminate, but security firms don't. But all these results, the statistical significance is not there because there's so much noise in alphas.
Okay, okay, okay. I, I, I mean, if I were to replicate your work, if I were to replicate your work, I would probably adopt your measures of advice quality as well. But on on the one hand, I got this impression, I got this, let's say, feeling that yeah, if you have private information, rather go stock picking. Yeah.
Yeah, if you have to replicate, because we got so in my because I was very influenced by Antoinette's paper on because they did a audit study to
Mhm.
get conflicts of interest, though that paper has now not been published for 10 years because they're having some issues.
Okay.
So there they did the classical method. So the classical method is look at index funds and you ask which index fund is being recommended, the one with the higher fees in which this guy is making more money.
Hmm.
So when you do that, then you will not face a lot of pushback from the profession because that's very clear. and then and so, but you can't do this in Hong Kong. So basically, we had to do something. It's like improvise to find
Okay.
out how do you define financial advice.
Yeah. Yeah. Okay. Okay. I get your point anyway in the paper. I just thought that I had this in the back of my mind, and I'd like
Yeah,
to hear your
yeah.
opinion. Yeah. Okay. Thank you. Thank you.
Thank
Yeah.
you. Those are excellent questions. Students, do you guys have any questions?
MS students.
Oh, no one's showing his face.
Yeah, it's pretty normal for them these days.
I see.
Um, Hi,
Hi.
my name is Pim Napa, and I'm one of the financial advisor working here in Thailand.
Oh my God.
So 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 yes, I have a lot of male clients, and some of them are female clients. But I want to ask you whether have you considered the fact that when in my experience, when there is a client, a walk-in client into my firm, usually they will my boss will assign the most junior member of the firm to welcome them, or just to greet them, or talk to them about like the advice. But it usually from the most junior member of the team. So is this the fact that you have considered, or have
No,
you
no, no.
thought about it?
This is very interesting. So the first time client is given the most junior.
You usually, if let's say if there is a client walking into my place, there is a very high probability that I'm the free guy walking around, and probably my boss will ask me to just go and meet that potential client that just walk in, because usually if the client has uh, usually when if you're talking about a very rich person, or they have a lot of assets, they usually not come to you. You have to come to them by connections, or by something like that, but not walking into the firm.
Yeah,
So it is with high probability that the most junior member of the team will go and greet them.
yeah, that's true. No, I suspect the same thing happens in Hong Kong too. But remember in Hong Kong, so I know in the United States, for example, this the private wealth managers, like the guys who they rarely do retail clients, but here the retail clients actually enjoy this private wealth management service. But the first time they are coming in, and with if there is a lot of wealth, and of course probably they'll be assigned a better person. If they don't have much wealth, they'll probably be assigned someone junior, that's for sure. But then how do you find out whether someone's wealthy or not? I have a question for you.
Yeah. I as I mentioned that usually here, especially in Thailand, if someone walking into your room, like someone walking into the firm, we don't really know that, right? But it is very high probability that that person is kind of like medium to low income, maybe, because if that guy's rich, usually they already have the portfolio somewhere. And
Yeah,
if we want to get that client, we have to like get through some connections, or like make an appointment to come and see them at their place, not as a walk-in guest.
no,
I
no, we
mean that.
we considered that. So that's why when we chose these auditors, we made
Mm-hmm,
sure that these auditors education level and trading experience
mm-hmm,
level and wealth level was not that high. Because for example, if we wanted to put an auditor who had high financial
mm-hmm,
literacy, then the advisor would get very suspicious, because she will say, how come you asking me for advice when you know so much?
mm-hmm,
So therefore these people therefore are lower middle class. Of course, sex ratio was 1:1, and so yeah, so these are not rich people. So they're the walk-in clients. typical walk-in clients, and they will get a junior guys. But that still doesn't bias our paper, right? So why is it that the junior guys then discriminate?
Okay. Thank you. Mm.
Hi, I'm Tom, and I'm in the department here too. I had a quick question. Were there any differences that you noted, even just anecdotal, between the, what is it, SF, the securities firms and financial planners, in terms of background or experience? In other words, would new college graduates become either a financial planner or a securities firm, or was there a progression? You start at the securities firm, learn the business, then you go to somewhere else. Differences in education level, other sorts of things. Even just anecdotal, I was curious about that. Thank you.
Yeah, so that's a very good question, because I visited quite a few of them. They just looked different, but I don't think it's a progression, because to be a financial advisor, you have to take a tough exam, whether you're in a securities firm or you're in a financial planning firm.
And that's what I was
I,
thinking about in terms of licensing requirements or
no,
something like that.
I
No.
think
Okay.
I think it's not the education level or the
Mm.
licensing requirement. It's the
Okay.
personality fit profile. Some people would like to be in this intense trading environment with the
Uh,
brokerage house, with
uh,
people coming and going and screaming and things like that. Whereas some people like to have businesses where they cater to client
Sure.
specific businesses. So I think it's a personality self selection.
Okay. I just was thinking like, a white tablecloth restaurant that's a much more exclusive clientele versus a more bigger place, get the people in, get them fed, get them out, more of a mass
So
market appeal.
the white tablecloth things do exist, and Hong Kong is one of the biggest
Mm,
wealth management places in the world. But
I can
those are for
imagine.
very rich clients, which
Okay.
is not in our set at all. We're
Yeah,
just
yeah.
looking
You
at retail.
specifically said you had that demographic of middle to lower. Okay.
Yeah, because we are looking at retail clients
Yeah,
only.
yeah.
Yeah.
Clear. Okay, I was just curious. That made me think about when thinking about the advisors themselves, and part of either their background, industry experience, education, something like that might be pointing toward something
and
that's
and there's
has
a reason we ruled out
to
the
factor.
wealth management industry with these white tablecloth things. Suppose you have one of these pretend people, an auditor who's pretending to be a client. You can't pretend to be a rich person for a long time, because these guys will ask you a lot of questions. So the wealth management industry is out.
Okay, great. Thank you.
I have one more question, very quick question.
Mhm.
Do the, oopsie, okay, my microphone is on, still on. Let's say a given, the same financial advisors, do the same advisors reappear in the sample with different clients? Say the same, it could be an advisor, right? One day I get the male, another day I get a female on a
So
different visit. Does
so
that
this
happen?
no no so this so we asked the people to get the name cards of these financial advisors. So I won't be able to answer that question, whether
Okay,
it's the same financial advisor that comes every time. But each
okay,
firm is restricted to between 4 to 6 visits, and between each visit we have 1 month gap.
okay. So yeah, okay. Thank you.
Hmm. Okay. About any other question from the audience, especially for the students in finance, or probably from others as well? Is there any other questions? Hmm.
Hi, it's Nick here. Um, I'm a master's at the program. I would like to ask a quick technical question on the regard of the how you classify risk tolerance. So here in Thailand, when the clients walk in before they do open up a portfolio and investment portfolios, they need to go through a process of knowing your client. So instead of telling whether the client is a high or low, it kind of try and quantify the customer in terms of a degree. So do you take this into account, or is it just high and low and that's it?
No, so that's a very good question. So when we were doing the pilot study, we found out that some banks, they want you to fill up what they call here RFQ, something risk profile questionnaire, something like that. And there's also a KYC form. So of course we couldn't fake many of the things there. So then we found out how many of these types of forms exist. So there are basically two or three types of forms, and they have some sort of a things like they ask you some vague questions, and later on found out that they're trying to put you in four buckets: high risk tolerance to low risk tolerance. So when we trained auditors and we gave them this binary thing, high or low, and we told them that if any one of them asks you to fill up these questionnaires, you fill up these questionnaires consistent with the avatar.
All right, so it's
That's
baked into your training.
yeah, you take that into take it. So you fake that.
All right, great, thanks.
Good question. Okay, is there any other questions? Yeah, please feel free to just speak up.
Yeah, please ask questions. Finance research is very interesting, and it's also very relevant. And all these social issues are very, very important. Financial literacy is very important. Gender is important, but I don't think as important as financial literacy. So now I'm going to delve more into financial literacy from here on. Um, Financial inclusion. Yeah, most of the world is just left out of this business, which is very sad.
But I believe that in Hong Kong, financial business is pretty much more developed than any other country, right?
Yeah, but developed for a certain type of people because, as you know, I don't know, we know, like in Singapore, Hong Kong has domestic workers, right? And most of the domestic workers are Filipinos, and some come from Indonesia,
Ah,
and they remit money home, right?
mm,
So so now one would think that a country, not a country, a place which is one of the world's leading financial centers would have an efficient way of remitting things home, right? But
mm,
they don't. And there's all sorts of issues like Filipino domestic workers have very huge, lots of debt. Then they take money from money lenders who charge them high interest rates. And so they don't, so that for certain segments of the population who are also taking, using financial services is very inefficient.
okay, well, that sounds bad. Okay. For finance students, one of the things that I would like to just mention before we finish this session is that I I think one of the things that Professor Bhattacharya presented, uh, it's pretty much like a good way that you guys should learn when you present your research proposal and the final work, because his presentation was pretty clear about how he formed the research question, developed the hypothesis, then conduct the study and analysis, right, toward the conclusion. I'm not sure if you guys even pay attention in the flow of the presentation, but that was one of the very good example that you guys should learn from him and from this presentation. Okay, if you missed it, then you will be very sorry, and yeah, you try to re uh, rewatch, you learn from your classmates. That's one thing that I would like to emphasize for this session. Okay, so Ajahn Pampitya, do you have any other point or any other questions then? All right.
ไม่ Professor คะ I'm Napason and I'm just curious. Since they got the buy-at advice, do they normally trade by themselves or just go and ask for the advice ค่ะ
What was that again? I didn't understand your question.
Like I'm just curious. Like, since they got they normally got the bias advice. So, do they normally trade study and try and trade by themselves or go and ask financial advisor?
So it depends. So uh, these days, what's happening is that all of these guys have got apps now. So both the financial planners as well as the security firms have downloaded for their clients an app, and so but the apps are not robo apps. Like they're not robo. It's not telling them what to buy and sell. So these guys go and ask for advice, and once they go and get advice, of course, remember our guys are fake. But in the real world, once they get advice, then they go to this app and they put in the order, and this order, of course, goes through the broker.
Oh, thank you ค่ะ
Hello.
Yes.
Hello, Professor. I have like a three question.
Three questions.
Yeah.
Wow.
In your research design, I'm pretty interested about the natural flow experimental. And can you tell me when you choose this research design with these experimentals, what would be the potential problem or the potential risk that you will have to consider about when you're doing the research design?
No, but
okay.
let's stop you there. Three questions is too much. You asked a question which is deeply philosophical. This is a question of methodology, which is the natural sciences versus the social sciences, archival research versus non-archival research. So there are pluses and minuses of both these things. But in many of these social science research, especially social science research, which has deep policy implications, our profession is starting to ask questions on causality. And when you ask questions on causality, these experimental methods are becoming more and more preferred. So in economics is far away from us. So they have done things like these big experiments that they have and randomized control trials and RCT and everything of that sort. So I won't be able to answer you in 2 minutes. You should go and read this paper that's cited on Floyd and List, and they look at the entire methodology of research in the social sciences.
Okay. And
What's the
I guess
second question?
okay. The second question maybe would be a little bit a long time to answer, but I still want. Then can you give me like a few suggestion if the student want to use this natural fields experimental in their research paper?
That's very simple to answer. As a master's student, you should not do this.
Okay.
You know why you should not do this? Because this needs a lot of. So it took us 4 years and $2.2 million. Where did we get all this money from? It was funding from the Hong Kong government.
Okay. And in the search, if the financial advice is biased, and I want to know your ideas. Do you think the client will behave as a rational investor? I mean, if the advice, if they get the bias advice from the
No. So remember, again, the very good metaphor for this is medical advice. So if you go to a doctor,
okay,
and the doctor is a bad doctor, as a patient, you don't know whether he's a bad doctor or not, right? So whether you're
yep.
rational. So this is a problem, asymmetric information.
So there could be the
Yeah.
selection problem.
So therefore, this is a problem. So why is the Hong Kong government giving us so much money? Because they wanted to know whether this is an issue in Hong Kong, whether these so-called guys who have taken the financial advice, this certificate, they've taken the exam, and part of the exam is this ethical thing on fiduciary responsibility. Are these guys working for the client's interest or are they working for their own interest? And they also wanted to know about the gender bias thing. So once the government gets to know the results, so then they will. See, first thing is that once you get to know results, then there's awareness in society. Once you're aware in society, the next time you go to a financial advisor, you may be a little more suspicious. And now the government has this thing where they've given them a list of questions. For example, you ask the financial advisor, okay, so you're recommending this product, how much commission are you making? So they have to now answer all these things.
Okay, thank you.
I have one probably last question that I want to ask. Basically, I don't know whether I see from the paper, I don't know whether I understand it right. So I saw that the financial planner, when they ask the question, when they talk to the client, somehow they ask about the client financial knowledge more than security firm. Is that right?
Yeah, they do. Yeah, I think they do. Yeah.
And the samples of the auditors that you choose, you say that they don't have much financial knowledge. Is that right?
Yes. Yes.
It's possible that when the financial planner, when they spend time with the client and they ask about financial knowledge, and at the end they find out that this client doesn't have financial knowledge. So that's why
Yes.
bad advice.
Yeah, it could be.
Okay. Thank you.
All right. Okay, I think it's about the time. It's about the time that we have arranged for tonight's presentation. And before we leave the sessions, let me say thank you so much to Professor Bhattacharya for the great presentation today. And I believe that everyone who have learned a lot, not only about like the research idea, but about this new area of finance, financial research as well. So let me say thank you so much for today.
Thank you, Tarakon. Yeah, thank you for the great questions also. This was very good.
Thank you.
And for the first time, I had someone in the audience who actually was a female financial advisor.
Yeah, and I believe that our students will have learned a lot.
Yeah. Okay.
Uh,
Thank you.
Thank you so
We
much.
hope to have a chance to welcome you in person.
Yeah, hopefully.
Very soon. We
Yeah.
hope. And we also have some document for you to sign a contact to your email. I send you
Okay.
email.
Okay.
And
Okay.
we are looking forward to having you guys, as visitor, on our campus sometime when the COVID situation is getting better, and
Yeah.
we definitely invite you to come and teach more.
So, so are you in Bangkok?
Yeah.
Yeah, we in Bangkok, at the center of the Bangkok.
Most of
It's center of Bangkok, but center of Bangkok has no space.
yeah, I mean like the central business district in Bangkok, business area.
Okay.
Yeah. Thank you so
Okay.
much. Okay.
Thank you everyone as well.
Okay. Thank you.
Have a good
Goodbye. Good night.
We'll contact you soon to the email.
Okay. Thank you.
Thank you. Goodbye.